Okay, Mike Swanson here. I got a presentation I'm going to show you today titled "You Have No Reason to Fear Missing Out on This Rally." And what I'm going to do is through some strategies for making money in the stock market, this PowerPoint presentation. Then I'm going to show you some sectors and some individual stocks even in the stock market that I'm looking at right now. And the thing about what's going on is people are getting very anxious about the stock market because they're afraid that if they hadn't bought into the market rally, that they're missing out on it, that the market's going to go up even more. So they have to buy immediately. And if they don't buy immediately, everyone else is going to make money. They're going to be left behind. And these fears are really being fueled by the financial media. You see, most people, they turn on CNBC, they see the market up, they get mesmerized by the stock ticker, and they hear all the news that's coming out on TV that they pump at you nonstop to make you think what they're talking about is very important. Then they have shows such as Fast Money and so forth, where they have experts on there that talk about the train is leaving the station, you must get in now, the market never will let you in, it's never going to pull back. That's something Jim Cramer was saying the other week. The market went down like one day, and he was saying it's going to never drop any more than that. It's going to go right back up. So you have to buy in right now. Subscribe to my newsletter. That's what he was saying. Actually, he's got a Facebook profile, and that's exactly what he put on it. And in the end, this is creating a herd type behavior. And we saw this last year where people sold in panic in unison on the bottom when all the experts on television told them there's nothing to worry about. Just hold on as everything dropped. And then, of course, people got disgusted. They sold out. The stock market crashed, and most people suffered. And now it's almost like the mere opposite's happening. The market's gone up the past several weeks. We've had a nice rally. And now everyone's being told, buy in right now. You're going to miss out, and you're going to lose on all the great gains that everyone's going to, supposedly make. And the media and these people understand, how nervous people are, and they're preying on your fears to keep you watching the television. And then Wall Street itself wants you to buy mutual funds. They want you to give them their money, and they want you to buy stocks. They'll make more commissions. But here's the thing. You have nothing to worry about. You have no reason to fear the market going up without you. And the stock market really did bottom, you see. That means there's better opportunities to make money that are to come than simply buying into the market averages. And I'll show you that today. But the reality is you never miss out on the stock market. Why? Because the stock market itself isn't going anywhere. Now, I don't mean direction there. The market may go up, it may go down. It doesn't matter. But the market itself isn't going to cease to exist. And as long as the stock market's there, there's opportunities to make money. So you're never going to miss out. Even the market, say you don't own any stocks and the market goes up and you don't buy today, you're still not going to miss out because the market averages, when you're in a bull market, aren't really the place where real money's made. And you have to always make money in the stock market using real strategies that measure risk to reward and do that the best according to the trend you are in the market. I'm going to show you in a second the strategies I've used over the years to make money and the ones I'm looking to use going forward. But no matter what you do, if you do this one principle, take this one principle away, that when you enter a trade or make an investment, you basically want to risk $1 to make 3. In other words, you may want to risk 10% on a trade as long as you have the chance to make 30%. That's going to make you money. And you repeat these kind of risk to reward positions over and over again, and they pile up, and make you money. You don't make money by getting scared that the market's going to go up without you, just throwing all your money at it. That's not how you do it, and that's what most people are doing right now. That's what's led to the market trading the way it has recently. But myself personally, I've been in the stock market for quite some time now. In the 1990s, I did what I would call swing trading internet stocks towards the end of that bull market. I basically looked for internet stocks breaking out to new 52-week highs. After they consolidated for a period of time, buy, sell a couple days later, find a new stock in that kind of position, do it all over again. Then in 2000, I short sold many of these same internet stocks on oversold rallies. They drop for a week or whatever, and I get out. I wait for another rally, and repeat all over again. and I kept doing that. And in 2002, decided that kind of strategy wasn't the best one going forward because there are better and newer opportunities appearing. And I primarily switched to investing in sectors. I focused on a few sectors in 2002 that were starting new bull markets ahead of the stock market bottoming. And that was primarily gold stocks 2002 and energy stocks in 2003. And that's basically what I did for the next several years. Then 2008, when the bear market broke out, I primarily short sold the broad market averages by using exchange traded funds. In 2009, right now, I'm still looking to do some short selling of the broad market at points, and I'm also looking for a change in trend in the whole market. But I actually have no interest in using exchange traded funds to go long the stock market as a strategy. Let me tell you why. The thing is, I think there's better ways to make money on the long side of the stock market than simply buying exchange traded funds to play the market rallying. I think using exchange traded funds to short the market in bear markets and in corrections is better than buying or shorting, individual stocks, because stocks have a tendency to gap up when they have positive news, and it's easier to just use exchange traded funds to manage risk on the short side of the market. You don't have short squeezes, for instance, and so forth. But for the long side of the stock market, I know there's lots of people who use futures or the exchange traded funds to trade long, but I actually think it's better to buy individual stocks. And that's the way I basically have always made money, by going long the stock market. It isn't by going long the indexes, but by going long individual stocks. I just think the opportunities of individual stocks are so much better. For instance, take a look at the gold market. When I started buying the gold stocks, our gold stocks trading at 50 cents, it went to like $3 or $4 in 6 months. They went up much more than XAU and HUI did. So bottom line is, when you're right about a stock, you can get a much bigger return than you can by buying the Dow or the S&P 500 or the NASDAQ with less risk. To get huge returns on the market averages, you used to use basically huge leverage, which I don't think is necessarily a smart idea. If you look, in 1999, I made lots of money trading internet stocks. And yeah, the NASDAQ did go up quite a bit that year, but I can make a year's return in the stock market in individual stock in a couple days, sometimes in a couple hours if you're in the right stock. So bottom line is, even if you're fearful that the market's going to rally further, and everyone on TV is talking about missing out, the train's leaving the station, and basically putting people into a buying frenzy, in reality, assuming for the moment that the bear market really ended in March, the best opportunities to make money are to come. They're not even right now at this moment. And I'll show you exactly what I'm talking about with some individual charts in a second. But I want to talk about it. There's basically, I think, 3 keys to making money with individual stocks. One is understanding the broad trend in the market. If you're in a bear market, it's really not that wise to go against the trend and even use individual stocks. In fact, last year, beginning of the year, or it might have been February or March, but I sent out an email announcement saying I'm not recommending any more stock picks, which is basically unheard of for a financial newsletter to do. Because look around, every single financial newsletter on the internet, that's how they sell themselves, by saying we got stock picks. And here I came out and I said, no stock picks, not for you. And the reason why? Because we're in the worst bear market ever, and I'm not going to give you stock picks just to do it. That's not what I'm interested in. I'm interested in trying to make money the best way we can. And in a bear market like we had last year, it may not even be over yet, stock picks aren't the way to go, because it's going against the broad market trend. Yes, we've had a big, nice rally, and it does look like there's a lot of things to be positive about and constructive about the market rally, but it's not 100% guaranteed that the bear market's over. And, no matter what happens in the next week or two, I do expect at some point this year we are going to get a pretty big snapback. And there's just more work to be done for the market to really, for us to be sure that it's in a bull market. But that's fine. The second component, though, to making money for individual stocks, besides not buying in a bear market, is analyzing the individual sectors. Forget about the broad market averages. If they've bottomed and they're in a bull market, that's great. That's all we need from them. We don't need to think too much more about them. Well, we need to analyze the individual sectors because that's where the big returns really hold. That's the real important key, is looking for the sectors that outperform the market and the sectors that begin new bull markets of their own. In 2002, gold stocks began a new bull market. 2003, energy stocks followed. And massive returns followed. They substantially outperformed the broad market averages. So once you know what sector to buy in and when to buy into it, how to figure out when a bull market starts, I'm going to show you that in a second, then you buy the top stocks in the best sectors. So how do you know when a new bull market starts? Basically, every market, you talk about this a lot, but quickly, you have 4 stages. You have a consolidation phase, which I call stage 1. You have a stage 2 bull market, a stage 3 topping phase, stage 4 bear market, which is basically what we had last year and going into March at the least. And after a bear market, you have a consolidation phase in which the long-term 150 and 200-day moving averages flatten out and go in the averages or the sector you're looking at tends to go sideways. And during that sideways period, the 200-day Bollinger Bands come together, and I'll show you some examples of that so you can see how this process works in great detail. But once they come together and the sector breaks above the 200-day moving Bollinger Band, then the moving averages start to act as support, and a new bull market begins. And the thing is, even though we've had this nice rally, there's very few sectors as a whole that this has happened with. So again, detect the start of a new bull market, 6 months consolidation in which the moving averages flatten out, 200-day Bollinger Bands together, then you look for the sectors in this position, and once you find the sector, then you look for the individual stocks that are poised to perform the best inside that sector. You take your position, you make lots of money. And this is how real money is made on the long side of the market. It's not made by panicking and just getting scared you're going to miss out, so you throw your money at the market because everyone on TV tells you to do that. No, you got to do homework. You got to buy in the right time, the right sector, the right stocks, and then you make some serious money. And what this means is, even though the market's gone up tremendously over the past couple months, you haven't missed out on anything, even if it goes up even more, because the real money is made when individual sectors enter bull markets. And let me show you what I'm talking about. Okay, what you're looking at right now is TC2000. This is the stock scanning and charting software I use to figure out what's going on in the stock market and find stuff to buy. But this is the sector medical practitioners. TC2000 breaks the whole stock market up into about 300 sectors. And this one actually did start a new bull market in April. These 2 red lines are the upper 200-day Bollinger Bands and the lower 200-day Bollinger Bands. The blue line are the 150 and 200-day moving averages, which, as you can see, flattened out and went sideways. And when the whole stock market made new lows, the medical practitioner sector actually held up. And it's been outperforming the market, in fact, since July. So anyway, the 200-day Bollinger Bands came together in April, and the sector broke above it to start what I think is a new bull market for this sector. They could pull back down to the moving averages. But whatever the case, the moving averages flatten out. Now they're starting to curl up. The whole stock market as a whole isn't quite in this position, but this is an example of what it looks like when a sector starts a new bull market. And there aren't really any sectors right at the moment that are in the position that this one was in back in April. But I'm going to show you some examples of some individual stocks, and I don't want you to buy them, but hold on one second. Okay, I want to show you some examples, then I'm going to show you some more sectors and what position they're in right now. But this is, do not buy this stock. The reason why is because it only does like 5,000 shares a day. Do not buy it. It's not liquid enough. But I just want to give you an example of what something looks like when it appears to be towards the end of a consolidation phase. Notice the Bollinger Bands are starting to come together right here. They're starting to pinch together. The moving averages flatten out. And this thing has been going sideways since October. This stock is called Wayside Technology Group, just a little rinky-dink computer company based in New Jersey somewhere. Do not buy this stock. It doesn't do enough volume. So anyway, it's coming together, and once it breaks above $8, it should start a new bull market. And you can see it's been in a bear market since 2007. But it's been in this stage 1 base basically since November. That's 1, 2, 3, 4, 5, 6, 7, 8 months. Okay? Let me show you another example. GPIC. This is a gaming company. It's got something to do with casino tables or something. But anyway, you can see it's been in a stage 1 base basically since August. Moving averages flatten out, gone sideways. And if it breaks above the opportunity Bollinger Band, it should start a new bull market. Another example, USMO, been in a stage 1 base since July. Moving averages flatten out. If it can, have a nice punch up to about 14 or so, it's going to start a new bull market. Let me show you another one, CRH. This is a cement company. Now, it's not quite in a position as other two are in, which look like they could do it, anytime now. This one looks like it'll probably go sideways for another few weeks, but it's in a position to start a new bull market. As you can see, moving average has gone sideways, Bollinger Bands coming together. And here's the thing about it. Let's look at these stocks. This is like $25. If you bought for $26 sometime, when it breaks above it, goes to a new bull market, it can be at $40 just like that. Okay, talking about 100% gain almost. WSTG, talking about buying something at 8, it could go to 12. Who the hell knows? It could go to 16. You're talking about doubling your money. USMO, talking about a $12 stock could be at 20 real easily in a new bull market. These are huge gains that are possible. Gains that you can't make by throwing your money at the stock market today or tomorrow just because Jim Cramer tells you you're going into a new bull market and the train's leaving the station. Train's not leaving the station because when markets are in bull markets and they're going up, what happens is individual sectors break out as time goes on. They don't all do it today. They don't all do it tomorrow. Some sector may break out 6 months down the road. Some sector can break out a month down the road. Whatever. It doesn't matter. You don't have to be focused on the market average to make money alongside the market. Now I'll turn to CRH real quickly here, and I'm going to jump to the sector itself, the cement sector. I'm going to show you a couple examples of some sectors and what they're doing. This is a sector here that's not broken out into a new bull market. It's bounced a lot since March. The moving average is starting to go sideways, and the Bollinger Bands are starting to come together, but they haven't completed the process. And even, if it's going into a bull market this year, they're likely to continue to go sideways, and this is likely to continue to go sideways the next couple months, then get into position later in the summer. And there's lots of sectors that look like that right now. They're not going to the moon at the moment, even though the talking heads are so excited. Instead, they're pausing, they're consolidating, they're in stage 1 bases, and if the market stays positive or pulls back and bases itself, they'll be in position to start new bull markets in the fall. They're not quite there yet, but they're going to be getting there if the market stays in a constructive, positive trading pattern. I'm going to just show you a couple more examples. Broadcasting radio. You can see the Bollinger Bands will take them a couple months to come together, and this could really be a wonderful sector here because it's basically going nice and sideways and doing the right thing. Let me show you an individual stock, AT&T. Okay, AT&T isn't in position to start a new bull market tomorrow, but if it just holds above 24 and stays between 27 or so for the next couple months, it's going to be in position to do that in the fall. That's pretty exciting stuff right there. Here's another sector, the publishing book sector, in the same position. Here's another sector, farm products. Now it's rallied pretty nicely. It's up near resistance right now. This is a sector to definitely keep an eye on, because as long as the market stays positive, it'll build the base. It'll continue to build a base, and it'll break out later in the fall. The danger, of course, is the market doesn't stay positive, and we've been fooled, and this isn't a start of a new bull market. But we don't have to worry about that. We don't have to, assume one way or the other. If we want to go long, all we got to do is just let these patterns play out, and these opportunities will line up where you can double your money safely in low risk, high reward individual stocks. Here's the top stock in the farm products sector. Archer Daniels Midland, $28 a share. The market pulls back or whatever, it's likely to stay in a trading range between $28 and $25 a share. And if it does that for 2 or 3 months and then breaks above 30, you're talking about a new bull market in that stock where it easily can go to 45. In fact, I think this sector's got the potential to become one of the best sectors going into the end of the year if the stock market stays positive. And I keep saying that phrase over and over again because everyone is convinced the stock market's bottoming on television. They're making you fearful that you're missing out, and you're not, because there's so many sectors. If the market stays positive, it'll line up. And there's a risk that you buy into some panic, a mass buying frenzy along with everyone else, because you've been mesmerized by the TV along with the other million viewers of the television media, that you're going to, in fact, end up buying at the top of this rally and really suffering. I don't want that to happen to you, because you don't need to make investment decisions based on fearing of missing out on something when better opportunities are around the corner. And if you lose money here because you got emotional, you're not going to be able to take advantage of stuff like that, because you're going to lose money, or you're going to be too fretted and frustrated to be able to do anything later on. So I hope this presentation helped you out. I want to show you some individual sectors. I want to show you philosophies on how you can really make money on the long side in the stock market, and you don't have to worry about missing out on the market going up or something like that. And I'll be talking to you later on.